Hello, good afternoon. This is Richard, and my name is Richard Monteroso, and I'll be going over financial management for small businesses. In this session, we will learn about financial statements and how to use balance sheets as a key tool to manage your small business more effectively. Nice to meet you. My name is Richard Monteroso. I'm a small business specialist. I help clients anywhere from when they start a business, they've been having their business for a while now, or they've been established for years. And sometimes what happens is that some business owners give their businesses to the next generation, like their kids or grandkids. So I'll help everybody out in between. So whatever stage you are in, I'll make sure I'll be able to take care of you to help you with your vision and make it a reality. I know my number's not on there, but however, if you need to reach out to me, please feel free to do so. My telephone number is 480-770-9858. I'll be able to help you out if you have any questions about your business, what to look at, what specifically, how to start. We can go over some ideas to make sure we can help you and take you to the right steps as well. Perfect. Agenda for today. Thank you all for joining us today. I appreciate it. Um, some of the common considerations for managing business financials are when we think about financial management, we don't often realize how much financial management tools can help us to keep us organized, and it's important to a small business. Today, we're going to review the benefits of proper financial management and overview of business financial statements, and later explore the critical role of balance sheets and how to use it to help you check your money. Checking your money. We will first start out by listening to some benefits in financial management and a high-level overview of financial statements. Reach your goals by making good decisions. How does your business make money? How does your business grow money? What does your business have set up to expand and diversify? And will these questions answer how can your business prepare for financing? Some of the things that we'll be emphasizing are knowing your value, forecasting your growth, prepare your financing, loans. So the reason why these are important is because by knowing your value, you're generating financial data that will allow you to identify your assets, liability, and equity at any given moment. This will help you understand your profit margins and allow you to manage your business more effectively. Forecasting your growth, it's very important. Sometimes there's businesses that they grow out of nowhere, and how are you going to adjust? How are you going to pivot? And those are the things that you need to be prepared in case you might need them, not need them right now, but you'll need them later on. I always look at these things as if they're your spare tire because sometimes you might need a business credit card right now. However, you will in the future. And depending on how you see your business is depending how you want to be prepared for the future. I have a lot of customers that use their business credit card for fuel. They're able to buy their supplies, whatever the case may be. You will be able to be prepared for instead of using your own money, you can just use the bank's money, so you can be prepared for 30 days, and you'll have 30 days with no interest for whatever you buy. And this will help you track your financials and plan to diversify new product lines and how to reach new markets with other lines of credit as well. Prepare for financing. Do you have proper funding? For example, if you might need additional financing, what if when you start your business there is a slow time, or it's seasonal? What if it is seasonal? Your business. What are you going to do there? Maintaining proper bookkeeping practices will help you identify potential obstacles and growth opportunities. Bookkeeping basics. There are ways to make your business more efficient and profitable. Generating financial statements as a tool will help you to see the opportunities as well as the gaps you have in making your business profitable. Remember to track all the finances going into and out of your business routinely. Some people, from my experience, is that a lot of clients don't know where they're at. Sometimes when they have to do their taxes, they don't have anything, right? And what are we going to do? How are we going to be more proactive in how to help yourself out? Because if the bookkeeper needs some receipts that you had, let's say in January, but you're doing your taxes next year, how are you going to be organized? And making sure you're organized is vital for your business to be successful as well. And remember to track all your finances going. All right, perfect. So now you'll need to reconcile accounts, make and track sales, deposit sales into business accounts, pay expenses from business accounts, generate financial statements. The most importantly, this is my favorite one, how to pay yourself. There's a lot of things that you can do to help you out when doing bookkeeping. There is a program and software called QuickBooks. With QuickBooks, it will allow you to help you with your bookkeeping that you need. And if you have any specific bank, they're able to integrate with each other. With US Bank, there is a lot of our customers and clients help out. That's how they keep track of everything with QuickBooks. So that might be able to take care of you as well and answer any questions that you may have with QuickBooks using that software. Financial statements. This will actually help you with the health of your business. There are three basic statements that provide different views of a company's performance. This will help you analyze a company's value and often require for obtaining any additional finance for a business that is already established. Cash flow projections. Um, it is a estimate estimates the money that you expect to flow in and out of your business. It includes your money, all your income and expenses, and it gives you a projection to cover about a 12-month period. You can create a weekly, monthly, semi annual projection. Profit and loss statement is a financial statement when a company shows its revenues and expenses during a particular period. It indicates how the revenues are transformed into the net income or net profit. And those are very important because it's going to show how much your business profits. There's a big difference between the gross of the business and what is the net income of the business. The gross income is how much your business made in a full calendar year, and the net income is after expenses, what was your take home? And that's why it's the profit and loss statement. You'll need the balance sheet. It's a financial statement that reports a company's assets, liabilities, and shareholder equity. This is a view of how your business looks at a point in time. Today, we'll be focusing on the balance sheet statement and how you can use financial data to manage your business more effectively. Let's briefly look at how these financial statements are interlinked. Perfect. The cash flow statement displays how much money you have in each month to cover expenses, like making payroll or buying more inventory. It is tied to the operating cycle of the business. What is cash flow? All right. So, with cash flow, there's two primary purposes that allow the administrator to identify the balance of cash received less the amount of cash paid out over a period of time. Also, review cash moving in and out of a business. For example, let's look at this cash flow projection. The first set of rows titled Source of Cash document all sources of incoming cash, including cash from customer, sales, interest earned, loan funds, and current checking and savings account balances. The second section, it talks about operating of uses of cash. It contains all your expenses associated with the day-to-day buying and selling processes. The third section talks about operating uses of cash. It shows the expenses not associated with operations, equipment purchases, the principal portion of a loan, inventory, taxes, and the owner's draw. How you pay yourself. Ending cash for 1 month becomes opening cash for the next month. The ending cash is interlinked to the new balance. Perfect. Profit and loss statement. These are called income statements. All right, perfect. So let's look at the formula for profit and loss statement. Sales. It's called income, also called income or revenue. That's the total amount from selling your product or services that month from a month or quarter. Cost of goods sold. Total expenses for inventory items which customers buy. Cost of goods sold consists of cost of purchasing the items, freight, manufacturing costs, modifications for services. This is the cost of providing the services, including labor, material used, and transportation. This is my favorite. Gross profit. Sales less the cost of goods sold. So how much it costs you for everything. Overhead expenses associated with your ongoing business operation, and net profit, gross profit less overhead. Balance sheet. Let's take a look at what balance sheet takes into consideration when they're displaying the financial data and how it's different from other statements. A profit and loss statement summarizes information about revenues and expenses, whereas the balance sheet yields information regarding a company's assets, liabilities, and shareholders' equity, provides a snapshot of the company at a point in time, reports assets at original cost, not appreciated cost, takes in consideration all the items that can be attributed to its purchase, including the purchase price, such as factors as commissions, transportation, and appraisals. Perfect. So here are some things to think about every time you do these things. So let's say some of the key factors to consider when building a banking relationship. It takes a couple of minutes in the handout. Um, if you know your value, forecast your growth, potential lending opportunities, these are the things that you want to review so you can know how to be more proactive as well. And perfect. Working with balance sheets. In this last section, we explored a high level overview of business financial statements. In this section, we will take a deeper dive into the role of the balance sheet and how you use to help you track your money. Why are these balance sheets so important? If you're working with a supplier or a client on an ongoing basis, you want to see their balance sheet. This will give you an indication whether they will have ability to pay you or whether they will be able to supply the inventory you need in the future. This is very important because whenever you do this, you'll be able to see how the client is actually profitable. Whenever you do anything with the bank, they're always going to want to look at your taxes. And some of the things that they always look at every time is there is there are clients that always write everything off, and what that means is that they always put a lot of expenses up on their business so they don't have to pay for taxes. And that is great. However, depending how you specifically want to see your business grow and you want it to be successful, you're going to want to show how much you actually paid, how much you actually made year after year. Because if you want to get lending in the future, the bank will need to know that you're profitable so you can pay back the loan. And this is very important because let's say later you want to finance a vehicle and you want to put it under the business, you're going to be able to. So you're going to need a line of credit so you can get money in the meantime while someone pays you. You're able to do that. These are the things that you want to do that are going to be very important because everyone's going to want to know that you're profitable and that you're able to meet and pay your debts. Financial statement basics. The balance sheet represents a point in time, and you can select a specific date when generating your report. So the gap principle governs how assets, liabilities, and equity are reported from accuracy and uniform reporting. If you're working with an accountant, you will want to understand the difference between what is reported to the IRS and what is used for business management. The IRS has certain rules that are different from those used by GAAP and lead to different numbers being reported on tax returns. The IRS looks closely at depreciation, amortization, meals, and entertainment for tax estimating. The balance sheet gets its name because everything on the sheet must balance out. You can see the equation of assets equals liabilities plus equity on the chart. This is underlying rational for all aspects of accounting and demonstrates the value of your company. Perfect. Another way to think about this assets is assets minus liabilities. What you owe equals equity or what the company is worth. Perfect. Now let's review a sample of a balance sheet. The assets on the left include the cash, land, and equipment. It is ordered by the most liquid assets at the top with the least liquid assets at the bottom. Now, the blue outline will go into more details on the asset types shortly. The total on this example is $472,100. The right side begins with current liabilities. It lists account payables and other debts. The final section is the owner's equity. This includes the money the business owner or owners have invested into the company. Retained earnings is the money and the company has left over after meeting all the other debts, taxes, and other shareholder dividends. Notice that on the left side and on the right side, they both equal to each other and they always have to match. If they don't match the numbers correctly, you actually have to go back and make sure the numbers match. And looking through this, you'll be able to find ways to improve your assets or decrease costs. And then we will dive into that in the next slide. When looking at assets of the business, you can review where you're holding the company value. These are the assets that can be converted into cash within 12 months. The darker colors indicate assets that are more liquid and available compared to the lighter colors on the right. You can decide if you have enough cash on hand to meet your expenses. You can also look at how large your receivables are. This could point out where you have customers that need to pay you or you are very late. Additionally, you can see how much inventory you have on hand and whether that makes sense for you and your business. This will allow you to adjust up or down depending on the needs of the business. You will want a sense of what you have in cash and the line items that can quickly be converted into cash, depending if you have any upcoming or unexpected bumps on the road. Now, what we're going to look at is long-term assets. These assets take longer than 12 months to turn into cash. For example, a business vehicle can still be sold for cash, but will generally be worth less than what it was worth the first day that you bought it. It depends on the miles, worn out tires, paint chips. We live in Arizona, so there's consistently rocks thrown at the car. We recognize that these are items lose value and they're categorized as depreciation. Long-term assets are listed in order in which they should be used left to right. Note that these are a continuation of the previous slide that we went over. Darker assets indicate more liquidity on the left. Depreciation is used to report the diminished of the value tangible assets such as furniture, equipment, buildings. Because these assets lose value over time, they are depreciated. With land, you don't lose value. That is why it is often separately listed on a balance sheet. If the property has natural resources such as oil, which are being extracted, these can reflect as depletion. I do apologize. Intangible assets are amortized rather than depreciated. For example, you can do intangible assets such as trademarks, copyrights, patents. Understanding the value of your assets and the impact they have over time will help you better prepare for expenses, and you can even help determine when you want to sell an asset like equipment, building, or land. So, for example, some depreciation you can use as furniture and fixtures are assets which would be movable and include things such as desks, chairs, bookcases, and, and partitions. Equipment includes all assets used in the business operations. It could be computers, equipment, manufacturing equipment, trucks will be categorized in this. Building, most commercial buildings lose value over time due to use and costly upkeep. Now let's look at liabilities. When analyzing a balance sheet, you will want to determine what current assets can cover the current liabilities. If not, you will want to implement a plan to meet current obligations. If not, your supplier may not provide materials for you in the future. Typically, account payable typically are paid within 30 days. So this is called a net 30. Examples may be raw materials or finished goods inventory. Notes payable list any short-term obligations of the business. Lines of credit are often included in this category. And the reason why is because with lines of credit, you're able to pay it off within 30 days and it will help you with your cash flow. Accrued expenses reflects any obligations that have been created but not paid yet. Common examples are salaries, utility bills, interest expenses, and taxes. Long term debts list the minimum payments that will be due on outstanding loans over the next 12 months. Here's one quick tip: if you're having difficulty making a payment, have a conversation with your supplier or bank. Don't just skip the payment. If once you start skipping the payments, it's a how I like to always explain it is a snowball effect, right? Because once you start missing one payment, then it turns into two payments, and then before you know it, it's going to be hard for other people, banks, to help you out to get out of that hole. So it's always nice to be proactive in making sure that you're doing the right things. And also make sure that you have someone that can help you out. And I would recommend getting a banker or someone from the bank that you are really comfortable with, that you can be like, hey, you know what? This is what I'm going through right now. What would you suggest me to do at this moment? Or when you know that business might be slow, how are you going to get yourself out? How are you going to go over that time frame, that season that you are slow? How are you going to be proactive? In business, it's very important to be proactive, not reactive. Managing long term liabilities. Long term liabilities are debts scheduled to be paid over time for a longer period. When looking into your borrow additional capital for your business, the bank will often look at your outstanding long term debts and see whether there is enough in the assets to cover the payment needed for longer term debt. Remember that the current 12 months of payments for loans are considered part of the current liabilities, but the balance of the loan is part of the long term liabilities of the company. Let's take a quick look at some of the long term liabilities. Term loans reflect on the principal balances owing on any loans with maturing greater than 12 months. Many times, commercial real estate loans are listed separately. Loans from shareholders report money into the business by the owners as a loan rather than a stock purchase. Banks often request the owner's debt, which means that the owners agree not to pay themselves back until the bank has been paid off. All right. Equity ownership. The last component of balance sheet is the equity. Some of the components of equity are for larger companies like stock, additional paid in capital, and treasury stock. For a small business, the key components include owner's investment and retained earnings. Common stock represents when a company in return for an ownership position. The value reported for common stock is the face or par value shown on the stock certificate. Some people pay more than par value for a stock in a company. The extra they paid is reported as additional paid in capital. Lastly, treasury stock is reported as an account when the business has bought back some of their issued stock, it is a reduction in equity. Owner's investment is the amount of money, personal money, that the owner or owners have provided into the company. The income statement connects the balance sheets through the retained earnings account when an account period is closed, and after any dividends or distributions are deducted, the total of profits or losses earned in the period are added to the retained earnings. Common sizing. So, for common sizing, one last takeaway: since the balance sheet is a point in time, it is valuable to compare one period against another to see the trajectory of a different line items. In this case, we convert each of the items to a percentage of all assets. This example is just a snapshot of the current assets section. In this first year, current assets make up 41% of total assets, but in the second year, they make up 42% of total assets. So, while the absolute dollar amount of the assets is lower the second year, you can see that is more of a current asset. The individual line items tell you that you had lower deferred taxes in the second year. By looking at your business this way, you can decide which areas you need to improve. Quick tip: by converting dollars into percentage, you can compare finances over time or against the industry average. Let's review a sample balance sheet. So we learned your assets are more liquid, your property and equipment is less liquid. Your liabilities are due sooner, and your long-term debt is due later. Equity is the value of your company after all of the liabilities have been subtracted from your assets. If you have any questions about any accounting, anything on this balance sheet example, I'd recommend talking to an accountant so they can give you more information about this. All right. So, um, let's review some key factors to consider when working with balance sheets. What assets can make more liquid if I needed to? Which liabilities do I need to pay down first? Which ways can I demonstrate more equity in my business? If I were compare if I were to compare two dates, how would I identify growth? Thank you all again. I appreciate your time for attending Managing Business Financials. Here are some key points to remember. Financial reporting and tracking your money through financial statements can prepare you to make sound business decisions better. The role of balance sheets can help you track your money and provide a snapshot of your assets, liabilities, and equity at any given time. Utilizing accounting purposes, software, a bookkeeper, QuickBooks, CPA help you with your business to understand your own financial position. Separating your business accounts from your personal accounts will make it easier for your CPA to help you with any financial, to see all the financial health for your business. Thank you again. I appreciate your time. If you guys have any questions, please feel free to reach out. My name is Richard Monteroso. Thank you for your time. And please feel free to look at any, you could use this QR code. You could bookmark the page. If you have more questions about anything we went over today, feel free to reach out. Again, if you need to reach out to me, I'll give my information And then we can go from there. If you need any questions, you can contact me by my telephone number. It's going to be 480-770-9858. Thank you, and I hope you have a great day.